Undoubtedly, Neeraj bhai, today we don't know what President Trump will do. His actions have been fairly unpredictable. We would have never guessed on political side he'll say Canada should become 51st state of US or Greenland should be given to us. On the commerce side, we would have never assumed that he'll be levying tariff as trade deficit with America divided by exports to America. But this is the world in which we are living in. Do remember that the objective of President Trump is appropriate. Even mighty US, the world's biggest, most strongest nation, cannot afford fiscal deficit at 6 to 7% year after year. So Great Depression is unlikely to occur because today both political class as well as central bank are far more cognizant about learnings of Great Depression. To a great extent, Great Depression can be blamed on very, very tight monetary policy of central banks around the world. I'm sure they have learned from the same, and unlikely that they will allow recession to go into Great Depression without taking appropriate action. At the same time, there are equally opposite cases where levying tariff has resulted into recession in US in 1828 as well as 1930. Now, there may be people who may see that this levying tariff is appropriate from the America's point of view because of fiscal deficit, current account deficit, and debt to GDP ratio. Will it create stagflation in US where growth is lower, inflation is higher? Quite likely, that is a possibility that will lower the global growth. If engine stops of the train, the whole train has to stop. And US is the engine of global GDP along with China and India. So one, there is so much of uncertainty that there's no need to hurry to invest. In the hindsight, we may feel, oh, this was a great level to buy. But when there is a storm brewing outside, it's far better to secure yourself and then think of opportunity. Number two, clearly domestic focused sectors will stand out in this storm. Undoubtedly, India's growth can take a hit if global growth slows down, but we will still be a positive growth. We will still be one of the fastest growing major economy. So your portfolio should tilt towards domestic focused sectors rather than international focused sector. Within these sectors, which could take advantage of opportunity as India has been levied little less tariff compared to others, there could be opportunities in textiles and garment. There could be opportunities in footwear. There could be opportunities in some of the pharmaceuticals and chemical sectors and so on and so forth. But please remember, if the American demand itself comes down, then these opportunities will be back-ended, not front-ended. It's not that American buyers will straightway shift from China, Vietnam, Thailand to India. One, their demand should remain consistent. And second, we should have capacity to service them. It's all going to take time. Market does discount future, but it's likely to be more back-ended than front-ended.